Okay, folks, welcome back. This is the Ict Time Disturtion weekend commentary for May 2nd, 2021. All right, I'm going to go through this briefly today. I gave you a really long video on Wednesday, so I'm going to try to budget the time because if I give you a lot here, you already have a lot going on for the week anyway. But the dollar index is our daily chart. I'm going to count you to go out to your own weekly chart, and you'll see this level here. That is the open on the weekly candle. It trades down into that for a bullish order block. Also, we're inside of the wick high to the open on this last down close candle, which is a bullish order block extended out in time. And we also traded inside of the fair value gap from this low to this high, and we have the sell side liquidity pool here that we were aiming for. So the market traded down into that. Also, you can see this here. That shaded area is optimal trade entry, 79, 62% relative to this low and this high. On the upside, we have the old fair value gap here. We have a small little portion of that left open. So we had nice reaction here on dollar on Friday, but we just return back to the fair value gap here. So it'll be interesting to see what we get in regards to continuation on the upside, or do we have to come back down in. Watch the open on this candle here. We have a short-term high that's been violated on the upside. So if we trade back down into the order block here, or consequent encroachment of the wick, either one of those levels around 91, big figure, watch and see if there's any support there. I'm not suggesting or making the case for it because obviously we're ahead of Sunday's opening. I don't know what we're going to do until we open. But if we get north of these highs here and trade above the fair value gap, watch and see if we get some support there as well. Smaller imbalance in here, and we have the volume imbalance back here. So two premium arrays should we continue on the upside. But if we open lower, we could have just simply returned back into this fair value gap to pick up more of a premium and then continue trading lower. I'm not trying to pick a top, I'm not trying to pick a bottom, that's not what we're trying to do here. But all in all, we didn't get the Thursday New York open low, but we did get a Thursday low. So here's Friday's trading, Thursday low of the week, and hits the order block there. Hourly chart, we have a buy side liquidity pool here on the dollar index, and we have this small remaining buy side liquidity pool that closes in this imbalance on the SIBI. Relative equal highs as well, so we'll see if it wants to punch up into that, close in that entire daily fair value gap, and we'll see if it wants to come back down into this breaker. We have a low, high, lower low, and again trading off that weekly bullish order block. If we trade back down into this up close candle here, that might be sensitive. That's also overlapping with the 62% retracement level on that daily range as I outlined. Moving on into euro dollar. This is a daily chart. Didn't quite get up in here and close that entirely. So we have the low here, the high here. We traded rather deeply, but Thursday, as I warned, typically every single week, that can tend to cap the weekly range. And again, didn't quite get the New York high of the week, but Thursday high of the week did form. We traded back down to this down close candle. Again, I'm not trying to pick a bottom, I'm not trying to pick a top, but we'll see if there's any sensitivity there. Should it continue lower, we have this fair value gap in here, sell side liquidity there, and then that old bullish order block there. Also, breaker. So there's a lot of things in here to look for in terms of downside objectives, short-term sell side liquidity pool here within the order block as well. Be mindful of that. But it's Sunday. We don't know how it's going to open. I don't know how it's going to open, but I don't see an immediate return back to these highs as we have in this chart. So I'm focusing primarily on the discount arrays on this particular pair. All right, euro dollar hourly chart. You can see we had the run up in here. I covered all this in Wednesday's very long video. Rallied up, breaks down. We have a short-term swing low that's broken to the downside with what? Sell side imbalance, buy side inefficiency in the form of a fair value gap. Trades up into it there, breaks lower once more, trades back up into the bearish order block, and then just simply rolls over, breaks the low. And I said if we traded below this low here, we would run for the 2050 liquidity, which is below here. And we had the buy side imbalance, sell side inefficiency there, and traded aggressively into that. We have a remaining sell side liquidity pool here that looks like it's going to draw to. If we trade back up into this buy side imbalance, sell side inefficiency, consequent encroachment should, which is overlapping with a potential institutional order flow entry drill, should we trade up into that before getting down here. I like the idea of that, setting up another round of selling, but again, that's guessing right now. I don't have Sunday's data. I don't have any idea where we're opening. It could simply just gap down and go right into that, or gap down here and trade back up. So again, it's something you got to be considering when we do our weekend commentary. But I'm focusing here primarily going into the initial part of this coming week. As we broke down, we have a small little fair value gap there. Trades into it, fills it, drops aggressively for the sell side liquidity pool, low resistance liquidity run. British pound versus US dollars is our daily chart. As I've been saying, this pair is tricky. It's really tricky. I mean, unless you're really short-term intraday trading, scalping, well, look at it. It's not a position market, is it? It's not a long-term swing trading pair. It's in this big consolidation. We have a buy-side liquidity pool residing here and a sell-side liquidity pool resting below these lows here. And that's about it. I don't know which one it's going to go for. I have no idea. We're back in equilibrium, basically, of the high and the low. So it could literally go either way. It can go from here higher. It can go from here lower. With the modest stance I have near term for dollar to see if it wants to go higher into that daily fair value gap and see if it wants to go higher, that kind of like gives me the near term confidence to guess guess now, because it's Sunday's opening, we don't know, but it looks like it wants to go maybe for this, and I don't know if it's going to go there. But this pair is very tricky, and you got to be careful with it. And it's been doing really difficult things for the daily chart. Intraday, not so bad. It's pretty predictable because you have very easy short-term intraday sell side liquidity pools, buy side liquidity pools, imbalances to fill in, that type of thing. But trendless on the daily. We have no bias whatsoever here, and it's just guessing. So is that a high probability market? Not at all. And here is the hourly chart. I mentioned last week this buy side liquidity pool would most likely get swept. We traded up into that, and then we started doing this business. Then it broke lower. Once it broke this low, we have an imbalance here. Trades right back up into the fair value gap, institutional order flow entry drill. All it has to do is trade that candle or higher there. Sells off aggressively, running for the sell side liquidity here, and then over here, and then we have the order block from the wick high to opening. That's what's being shaded here and projected over there. And we have this fair value gap here that I showed on the Friday daily PDF for daily log entry. So that's where that resides there. And I want to talk a little bit about how this movement here, okay, is sometimes a little confusing. But before I get into it, we have this fair value gap as well. So we could see it jump up into here before going lower reaching for that daily sell side liquidity pool. So I'm watching in here to see if it gets up there. Otherwise, I'm just going to watch and do nothing. But if it does get up in here and gives me something to short with, now I'm not saying this goes right here and then I'm going to sell short. No, I needed to go up into that level, and then on a 5-minute chart, maybe 15-minute chart, is giving me a imbalance like this, then I'll trade that one after leaving it here, and then I'll try to target this and maybe hold a little piece on for the daily sell side liquidity pool. But again, that's speculation. It's all guesswork right now. I have to see what we do on Sunday's opening. But I want to talk a little bit about the element of time. And while this topic could be mined for months and just scratch the surface, it's very easy for me to get into a very long-winded lecture about time as it relates to the marketplace. But for this discussion, I'm just going to cover what is going on in here, and I've covered this in charter member level. So if you look at how charts can be deceiving, okay, and it's one of the things that I look for when I'm in deep study with price and I have a underlying narrative what I'm thinking the market may do. Let's go to the next chart and we'll start fleshing it out. I want to talk a little bit about the distortion of time in charts. And what is that? Well, obviously this is a 15-minute time frame on the euro dollar, and you can see the consolidation, the run up, optimal trade entry, rally, and then all this consolidation in here. Then we break aggressively lower to attack the sell side liquidity there. Price charts can by default create a lot of distortion and chaos that you have to decipher in price. There is a simple way of breaking it down and also omitting. That means omitting, not like paying any attention to a specific range of data. What I'm showing you here is a range in price that is inside of this candle's low, this down close candle, that low, and this up close candle's high. So that is your dealing range. Notice how it retraces up into it and then stays inside that shaded area, not going above this high, not going below this low. But prior to all this consolidation, we have this dealing range here to here. That's all that you need. Then any price being held inside that range, this is all irrelevant until we leave this low, which we have right there. Okay, so this candle here, we leave this price range. So now what I do is, now I'm going to physically remove all of this data and take this candle and everything to the right of it, and I'm going to place it right there and remove all of this. Now this is going to be extremely confusing for the new students, but I promise you, as you go through your charts and as we go through more teachings this year, you'll start seeing what I mean by this. But it's not practical, it's not realistic for you to believe that you're going to understand this from the first time I talk about it. Try to resist the temptation to send me emails asking me to go over it more specifically and more detailed in an email, because I'm going to teach more about this type of thing as we go throughout the year. But I have already touched on this topic before for charter members. This range in here is of no importance to me, because all I need to know is this range high and this range low. Now, why is that significant? What's so important about that? Well, if we are anticipating a weekly high forming on Thursday, here's the 30th on Friday, and all this data here on the 29th is Thursday's trading. We know that there's a likelihood that the market, since it's going up for the week, could be creating a high of the week on Thursday. Now it actually forms its high on the 28th. So on Wednesday's data, it creates the high of the week. It's of no consequence, really. No, don't worry about that part. but we're anticipating the likelihood of it retracing going lower. This high and this low is your dealing range. As long as price is inside that, any movement here just is basically distortion. Distortion is the effect of using a time-based chart. So if you were looking at price, every single time it creates a new 15-minute interval, it's marking the highest high, the lowest low, where it started trading for that 15-minute candle, where it stopped trading for that 15-minute candle. So the chart is forced to mark time and where price is at for that relative period of time. Charts in and of themselves do not time the market. This is what I'm referring to many times when I touch on the topic of seeing things outside of charts, because the charts themselves aren't necessarily what I'm looking at. I'm looking at things behind the chart, which is some of what I'm going to show you here. But just understand that I already know, saying this and teaching this lesson to everyone, like for everyone that just came in 2021, for everyone that hasn't become a charter member yet, it's just going to create an influx of emails, and I'm just going to reply to you, wait for more lessons. So that way you know beforehand, before you sit down and you write these really long-winded emails saying, I need to know about this. You don't need to know it right now. I'm introducing it, okay? The idea of price staying inside of this high and this low and just staying consolidated for all that time, nothing in here is important until we leave that low. Now, that's not to say that I'm a breakout trader or I'm doing a breakout trade, because the idea is this is a market maker sell model. But with all this elongation in price, where it just keeps on going sideways inside that range until later on and then it breaks down, it doesn't look like a classic market maker sell model as I define it, but it is. The only reason why it doesn't look familiar to you is that it's got this long drawn out distortion here. So the benefit of knowing what dealing ranges are, and we have that dealing range high here, we have the dealing range low here, the anticipation is we're likely to see it go lower. So if that's the case, we know that if we break below this low here on this candle, that means that it's likely to start running for that liquidity there. But from a perception or vantage point, I ignore all of this. As it's doing all this, I could care less. My eye is going right to that low and that high, and I'm watching to see when that low is taken, and it does it right there. Then all I'm going to do is ignore all this data, and in my mind's eye, I'm imagining what I'm going to physically do for you here. I'm going to take all this data out of the chart and take this and place it right over there. Everything will stay to scale from this candle to the right. This low will be right where it's at, but just moved over. So in other words, if I was to take an editor, okay, an image editor, and just simply cut this whole area out of the chart, cut that out, and it was able to just swing this and fill in the part I took out, the chart would look like this. Now, doesn't that look a lot more closer in resembling a market maker sell model? You don't have that distortion in here. So all of this run up, it creates the classic optimal trade entry. Fair value gap closes in, it breaks down, comes back to the bearish order block, sells off once more, comes back in, fills in the small little fair value gap there, breaks down, trades back up into the volume imbalance there, breaks down, continues, fair value gap, institutional order flow entry drill, boom, hits it, sells off, fair value gap there, sells off, and everything looks exactly like it normally does as I describe it. This is, like I said, it's a very high degree of skill to be able to look at price and ignore certain candles, and it takes experience. By understanding dealing ranges, by understanding the high and the low here, that premise helps you build an understanding about price, and you don't necessarily rely on all the data in a chart, because all the data in a chart isn't necessary. And this is an evidence to that, because the underlying narrative is, because if it breaks this low, it's going to be going lower with the highest probability of running out this sell side liquidity. So when I'm looking at price, I'm kind of like ignoring certain parts of price based on a narrative that I may hold or may be adopting soon if there's a specific criteria. As I mentioned on the PDF on Thursday, if we broke below the 21 big figure, we would attack the 2050 liquidity. That was all based on what I'm showing you here. I was looking at the likelihood of this dealing range presenting what I just basically gave you. Because if we do consolidate and it stays between this high and this low, then this scenario would likely pan out. So let's take a look at cable. It's similar to that. So now we have a much more defined dealing range, consolidation extended going to the right. Dealing range high, dealing range low. The market just stays inside that range until it breaks. Okay, it breaks right there. So now I'm going to take all this data and place it right over here because it's breaking below that low. So I'm ignoring all this run up in here because it's useless information. It has no storyline, it has no importance. It's not salient to the underlying narrative here. It's just the market is being held by the algorithm inside that dealing range high and that dealing range low. So if we are bearish, or if we're looking for the likelihood of a bearish move lower, you have to define what existing dealing range you have, and once it takes a move below there, the algorithm will snap into a sell model immediately and attack that right there. All of this in here is chopping wood, it's marking time, it's not doing anything, it's being held in consolidation. So I ignore all this, where everybody else would like to look in here and measure this and put swing high measurements here, and I don't do that. I cut right to the chase, and this is a dealing range low I'm looking at, the dealing range high. It's likely to go lower and attack the sell side liquidity. This here, I don't care about any of this until we get a break below that low, because what's actually occurring is I'm getting a market structure shift. Once the market structure shifts below this low, then everything I'm anticipating becomes easy again. All this here trades right back up into the balanced price range. This little candle here and this little candle here, that's why we're not trying to go up into it. We created a balanced price range, which is also below the dealing range low. It doesn't need to trade back up and close that in. It's ideal that it doesn't. Trades up into the fair value gap, institutional order flow entry drill, breaks lower, and aggressively cascades into the sell side liquidity there. But now watch what happens when I take all this data out of the chart. Now I'm not doing this with my charts. I'm just ignoring all of this. Now when you're looking at your old data, you can practice with things like this. What I did was I took a picture of this chart and then I dropped it into MS Paint. And then all I did was simply just, blocked out this area, removed it, and then highlighted all this area and just moved it over to match with this low. So this candle here goes over to here and all this data goes away. It's, again, I already know some of the new students are scratching their head thinking like, what is this and what is he talking about? Like, this is nonsense. It's not nonsense. What I'm doing is I'm removing the portions of price that have no real part of the underlying narrative. When the market's trading consolidation like this, it could be in the form of waiting for a news data release. It could be in the form of just a kill zone starting. It could be in the form of a new day starting. Here's the 30th on Friday. It starts there and just rolls out of that range. But as soon as it breaks that low, you understand this even from my free tutorials. That's a shift in market structure. It's now going lower. So if it starts to break down, where does your eye go? Boom, right there. Relative equal lows, that's the pool of liquidity it's going to target. Just right there? No. Start doing 10, 20, 30 pips in terms of grades going lower. Now let's take all this data out and that distortion. Let's remove it from the chart. And suddenly everything becomes crystal clear now, doesn't it? This is why I tell you, and this is why I make fun of the folks that pretend to know what I do. They have no idea what they're doing, and they're looking at candles calling them order blocks when they're not order blocks. They're all part of areas of price where the algorithm is just marking time. It's not doing anything. So to strip that out of your chart and get to the heart of what's going on, you have to understand what they are in terms of periods of marking time. Just consolidation. It's not trying to do anything. It's just being recorded because of the element of your time-based chart. So charts in the hands of someone that doesn't understand this could be used to fool them. Even understanding the basics that I teach on YouTube, if you don't understand this principle here, you can fall victim to looking at candles and thinking they're order blocks, and they're not order blocks. You have to know what the narrative is that we're possibly going to see unfold. Everything here is your classic ICT market maker sell model. Consolidation, it breaks out, returns to the consolidation here, rallies again, reaccumulation, high, smart money reversal, low risk sell, distribution, redistribution, another level of distribution, and then washes out the sell side liquidity pool and into the hourly order block. Beautiful, isn't it? Now, you're not going to find that in Wyckoff. There's no schematic in Wyckoff for this. Okay, there is no supply and demand lesson like this. Okay, and I know I sound facetious when I say this, but I do this because it's irritating to see these yahoos on the internet try to make a case that what I'm doing is rebranding or labeling something that's been around, way before me. No, this is me. This is all me. And when you strip away the non-essential data in charts, now here's the thing. There are lessons that's going to be required for you to define all those things. And I can't teach them to you in one go. I can't sit down in one video and say, this is what you're doing here and this is what's not important. It takes other lessons that call on other lessons that bring everything into clarity. That's why it takes mentorship, not here's a video and you understand everything. Because if it was that easy, I would have just did it and been done. This lesson highlights the importance of, number one, experience, wisdom, knowing what it is you're looking for. And here's the thing, knowing what in a chart will cause you to lose money, what in a chart is non-essential, and what is essential. Stripping the data away. Okay, it's not just simply saying, oh yeah, this is a run up and price moves goes lower. It's not a mark up, mark down, not in the sense that I just showed you, like this chart here. This doesn't fit the schematics of the classic Wyckoff crap. Okay, it doesn't do that. Now, I'm sure there's somebody here, oh, well, let me go in here and I'm going to do all this lipstick and forget about it. Show me how you shorted it, okay? Show me how you shorted it with that stuff. That's the thing that I would like to see. But when you start using what I'm teaching, you get this. You're stripping out all the data that has nothing to do with how the algorithm is going to reprice. Because this is what the algorithm sees. It does not care about all this. This is nothing. This is what it's referring to because it's all relative to the dealing range. And once it leaves the dealing range, everything starts to move lower. What's over here? Accumulation of what? Longs. Okay. What's this here? That's the smart money reversal. So everything to the left of that is the buy side of the curve. Everything to the right of that is the sell side of the curve. So all you're doing is matching up where the buy side is, it becomes a sell side over here. They're buying in here. Well, over here, they're going to be selling in here. Over here, they're buying. Okay, well, they're going to be selling over here. They're buying right here. Okay, we're selling right here. Folks, that's not Wyckoff. Okay, there is no Wyckoff schematic where they match up buyers and sellers, sellers and buyers. That doesn't happen in any schematic. It doesn't happen in Wyckoff. It doesn't happen in supply and demand. Nobody knows this stuff until I talked about it. Period. And yes, I climb up on my high horse when I'm on social media and I talk my talk because it's mine. There's no books out there, folks, like this. Okay? No one covers anything like this. If I wouldn't have put on the Eurodollar PDF stating that if we break the 121 big figure, the catalyst would be in motion that sets the stage for a sell-side liquidity pool run to that 120.50 level for the liquidity. If I would have been teaching this lesson without that, a lot of you have been like, nah, come on now, he's making up stuff. But I'm telling you why. I'm telling you why I felt that was likely to occur. Because the dealing range was in place for Euro, just like the dealing range was in place for cable. And once you understand what you're looking for and you know how to read the market, what the algorithm is likely to do, because it does the same type of thing all the time. There's certain little macros that it does, and a macro is a short little list of procedures or an order of things that it does. And once you understand what those are, if you know what you're looking for a bullishness or a bearishness in the marketplace, you just simply wait for the things to occur. And then once you understand these things, is it hard to be patient in that instance? No, it's not. Because you know what you're looking for and you know what you're waiting for. Contrast that with how you feel probably right now as a new student that came in 2021. Or maybe you're a student that's about to become a charter member. You just can't wait. You're chomping at the bit. You want to learn all the models. You want to do this. You want to do that because you want to start trading. You, if you were asked in confidentiality, you probably would admit that you're impatient. I'm not impatient when it comes to trading. I know what I'm looking for. This is the reason why I'm patient, because I know my binary thought process around all of these concepts because they're mine. I know what I'm looking for. I know when they're likely to form. And here's the thing. If it doesn't form, am I going to jump in because it didn't form and I just got pissed off? No. I'm going to wait until another setup, or I'm going to wait if time permits it to see if it will eventually give it to me. So it provides, once you understand what I'm showing you here, and again, I'm not stating or even beginning to pretend that you understood what I just showed you. But hopefully you can see by me stripping away the non-essential data in price, where it's just marking time, that if a range of data in any market stays within a defined high and low and it's just going sideways, strip all that stuff away until it leaves the range low or the range high, and you'll start seeing things much cleaner in the delivery of price. It will become obvious what's going on, because that's exactly what the algorithm's doing. The algorithm goes back from here. Once it breaks down below that low, it jumps all the way back to that candle right there, that down close candle. That's what it's doing. So if it does this jump back to that reference point, shouldn't you as a trader do the same thing? Because that's what I do. And that's why I'm precise. That's why you see me trading, and my executions and my analysis is so spot on, because I know what the algorithm's going to do. That is why I'm patient. It's not because I'm smart. Okay? It's not because I'm a genius. I'm not any of those things. I just follow rules. The rules are established and in the algorithm. So if the algorithm is going to follow a rule-based structure, and it's going to refer back to specific price points and PD arrays, What's this PD array? It's an old low. That's a PD array. It's a discount low. Once it's broken, and now we're trading below it, what's this become now? A premium array. This low is a premium array once we start trading and close right here. Does it have to come back up to that? No. In fact, it's better that it doesn't. Why is it better that it doesn't? Because if you look over to the left, you have this fair value gap there. And now we created this one. Once you have this established here and here, a single pass up and a single pass down in the same area, I've taught this before. Do a search on balanced price ranges in the forum, and you'll get the lessons that I talked about this. Okay, it's in the commentaries. You don't want to see it go up here, and if it does, it'll act as stiff resistance. It'll trade. In other words, any one of these candles here or here could have punched up into it just to touch that level there and then send it like this. But this being a balanced price range, I'm anticipating it not even trying to get back up there because the algorithm has waited long enough here. Now what I just dropped there was a gem. The longer you stay in a consolidation above a single fair value gap that creates another single fair value gap on the downside, the more likely there is a balanced price range. You don't get a balanced price range with a run like this and immediately come right back down. That's not a balanced price range. That's something I would expect to see it trade back up to the consequent encroachment or completely close it back in to rebalance and then go lower. But when we've had this single candle up all this time here and then a single break down, that to me is going to be balanced price range, and you can anticipate moving lower as a result. But look at this chart here and contrast that with this. It's much sharper. The interpretation of price is easier to follow because you don't have the distortion of time, because this chart is 15 minutes. It has no choice but to mark what the chart is showing relative to its high and low for each new 15-minute interval. So if the data is being forced into the chart because price isn't going any higher than this high or any lower than this low, or this low rather, it's not going to create anything that's useful in chart patterns. Again, this gets back to what I was saying on baby pips in 2010 and onward. Charts don't move price. Your patterns don't move price. Your indicators don't move price. Your supply and demand zones don't move price. Your Wyckoff schematics do not move price. The algorithm moves price. That is the mechanism. That is the driver of moving price higher and lower. And it's controlled, it's programmed, it's manipulated when it needs to be manually, but otherwise it's autonomous. It just does what it's programmed to do. Now, if it wasn't programmed to do these things, how on earth would I know to do what I just showed you here? And this isn't the first time I talked about it. Charter members have seen this before. It's logic. That's how I know these things are going to repeat, because they're programmed to do the very things I'm showing you. So I could talk and talk and talk, obviously, and it'll probably just dig a deeper hole because I need more lessons to build structure around this idea. In other words, you'll get lessons throughout the year that help define why this dealing range is salient, when to anticipate the consolidations, which causes the distortion in price in the charts. So that way you can go in and start doing the same thing. And now this is dramatic, where you're slicing and dicing and doing surgery and making the chart look different than what you would normally see on this. I made a mistake one time on baby pips, and I showed a chart like this. And once I posted it, somebody came on and said, where'd you get that chart at? And to avoid the conversation, I just deleted the chart and ignored every reference to it, because I wasn't touching that. I put the wrong chart up on baby pips. But it was me doing this very thing here, because I wasn't going to teach that. But it's just some of the things that I do when I'm looking at data and charts, that I can go in and scoop out all the things that are not important to read price. I'm telling you, folks, classic support and resistance is not the answer. and all these other retail things, they all will fall victim to things like this. They're going to. And that's why the algorithm does these types of things. It holds the price in consolidation to allow sentiment to build up. But if you know what you're looking for and waiting for, once it fulfills it, everything resumes and goes right back to the way I teach it. But you have to be able to take that portion of data out of the chart, or find a way to ignore it. And how could you do that? Well, you just draw an annotation on this close here, and then mark out on your chart with a shaded area that this is an area you're not looking at. You disregard it, and then once it breaks lower, you annotate that as now we're going back with a market structure shift here, and then you treat it like a simple run to that sell side liquidity pool. That's the best thing you're going to do. Otherwise, you're going to have to create these charts here, and unless you do a really good job of annotating what it is that you're showing, you'll forget what you did here, and you'll forget that this is not what the chart actually looked like when it looked like that. So again, I know your head's probably spinning. You're probably thinking, man, this doesn't make any sense. I don't understand it. And it's probably frustrating for some of you, maybe like me, because if I would have saw this lesson the first time as a new student, this would bug me. I gotta know right now. You don't. Okay, trust me, you don't. And you're probably thinking, well, if I don't need to know it, then why'd you even bring it up? Because I have to bring it up in parts and slowly bring it together. Okay, that is mentorship. Mentorship, when you're learning something like this, isn't a one lesson you understand it all. Okay, it's a process of understanding simple procedures and concepts that lean on one another to get this depiction of price. And it's rule-based, and it's logic that you need to understand to be able to do it. And once I flesh that out for you throughout the year, this time next year, you'll know exactly what you're doing when it comes to stuff like this. And you'll see things in price that no one else, unless they've been trained by me, will see. And you'll be able to read price. You'll see things that nobody else literally sees in these charts. And they could be looking at the same chart as you, and you'll see something entirely different. And you'll be the smart money in that equation, and they'll be the street money. Until I talk to you next time, be safe.